morning and welcome to Business Morning. I'm Chimeze Obi Iwagu. Well, it's the day 2 and final day of the rate-setting meeting and of the Central Bank Monetary Policy Committee. And at 2 p.m. local time, the Central Bank Governor, Mr. Godwin Emefiele, will be announcing the decisions. At its last meeting in November 2018, the MPC had maintained the monetary policy rate at 14% with the asymmetric corridor at plus 200 and minus 500 basis points around the MPR. It also retained the cash reserve ratio and liquidity ratio at 22.50% and 30%. Well, the MPC has kept the policy rates at the current levels since July 2016. Let's look at some of the issues. And joining us now is the MD/CEO Cowrie Assets Management Limited from our Abuja studios, Mr. Johnson Chukwu. Good morning, Mr. Chukwu. Thank you very much for joining us on the show this morning.
Good morning.
Now, the Monetary Policy Committee meeting being held is the first for 2019. Of what importance does this MPC meeting hold for the Nigerian financial market and the economy?
Well, the decision of the MPC ordinarily should signpost which direction monetary policy authorities want economic activities to go. The reality is that is a benchmark. They define the benchmark rates. That is the liquidity ratio, which will determine how much is available to the banks for lending purposes. They determine the monetary policy rate, which is actually a benchmark for interest rates, and they also determine the cash reserve ratio. So these are key factors that will determine the level of liquidity in the economy, the cost of credit, and the willingness of the monetary authorities to see either injection of liquidity into the economy or withdrawal of liquidity from the economy.
Now, just yesterday at the Davos meeting, the IMF reversed its economic outlook on Nigeria from 2.3% this year to 2%. Is the economic outlook in Nigeria optimistic or pessimistic, given the key economic indicators such as inflation, PMI, exchange rate, crude oil price, foreign reserves, unemployment? Of course, we're talking about the GDP growth.
Well, if you look at even the basis of which IMF revised their expected growth of the economy to 2%, it's basically one of the key assumptions is that oil price has dropped and oil price is going to trade around $55 to $60 per barrel. And I'm also sure that they factored into the fact that this is an election year and there's heightened political activities which have actually decreased the level of economic activities in the country. So reality is that if you look at some of the parameters, if you look at the Purchasing Managers Index, it's actually in a expansionary range, which indicates that there's confidence. But beyond that, if you look at the GDP growth rate, we saw a GDP growth rate that came at a print of 1.81% in the third quarter of last year. We've also seen an uptick in inflation that has moved from 11.28% to 11.44%. But most importantly, the most critical component of that inflation is the food inflation that has moved about 13.56%. So these are not indications that of an upside potentials in an economy. They are actually threats to economic growth. And I think if you have to use those as parameters to determine the outlook of the economy, one would say that the outlook is not quite bullish.
Mm. And what are the expectations on the MPC decision on its policy parameters, given the current key developments in the domestic economy? Will there be an upward or downward review, or will the status quo be maintained?
I think the most likely outcome is that the status quo will be maintained. The simple reasons are this. In the first place, we saw, like I mentioned earlier, we saw an uptick in inflation rate, which has moved from 11.28 to 11.44. What that means is that the monetary policy ordinarily should put a brake on credit or availability of liquidity, which will imply increasing interest rates. But given that the economy is growing at 1.81%, they can't afford to take any measure that further decelerate the already very sluggish economic growth. So they are actually caught between two difficult decisions. One, to stimulate the economy by lowering rates, but you have to contend with inflation. You have to contend with the pressure that will come to bear on the exchange rate at a period when foreign portfolio investors are exiting the Nigerian economy. Or, on the alternative, to put brakes on liquidity as to fight inflation. Then you have to deal with a high level of unemployment. We're talking about more than 20% of the working population are unemployed. More than 20 million Nigerians are unemployed. So you're going to worsen those conditions. So in such a situation, I think the only option that it will be left for the Monetary Policy Committee is to keep rates at current levels.
And based on that, what are the risks to price stability, financial stability, and economic growth in the near term?
Well, the risk will be coming from the political environment, not necessarily from the monetary angle or monetary window. The reality is that if we do not have a very peaceful election come next month, then a lot of things, the bet will be completely off. Monetary policy stability, economic growth will be largely dependent on how the elections of next month and the next 2 months, that is February presidential and National Assembly elections, and March gubernatorial and the State House Assembly elections go. If we have free and fair elections, then we should expect that, one, confidence will be restored in the economy, the political risk that's actually hanging over the economic space will be lifted, and the economic agents will go back to investment activities, including some foreign portfolio investors that will come back, and also foreign direct investors will be looking at our direction. But so the most important risk that the economy faces today is the political risk. And one is hoping that we will have a free and fair election. The outcome of that election is accepted by all the participants, all the electorate and the key contestants, and that we move forward and new policies are actually enunciated by whoever is elected into government, so that could actually drive stronger economic growth.
All right, let's look at what's happening in the markets. How would you describe the current investor sentiment in the equities and, of course, fixed income markets?
Well, what you observe that the equities market, the investor sentiment is quite finicky. You see situations where when there is huge bargaining opportunities available in the market, investors go quickly to see if they can take short-term profits. And immediately they gain 2-3%, they're actually exiting, because it shows that the confidence level is very shallow at this moment. Reality is that the fixed income market is the beneficiary of a weak confidence in the equities market. And what is driving that is that at periods of political or economic uncertainty, what investors do is to underweight their portfolio on variable income assets and overweight them on fixed income assets. So people are doing what we call flight to safety, moving their funds to fixed income instruments, particularly short end of the market, where they could have opportunity of repricing when the environment stabilizes.
Okay, now, is the market outlook optimistic or pessimistic, having in mind the recent bearish trend in the local bonds as well as performance in the fixed income market? Can this be attributed to the downside risks of the capital flow reversal?
Well, if you have to answer the question from where they came from, is it optimistic or pessimistic? I would say that it is tending towards pessimism, but the reality is that what we have is a market environment where investors are on the edge. They're looking for good opportunities that can actually exist at very short term. They're not ready to play long. Investors are conscious of the fact that at this point, they can take very high equity risk. So reality is that we are facing an environment where investors' appetite for risk is quite low. But be that as it may, one expects that the outlook of the economy will be better defined immediately after the elections.
What are the likely ripple effects on the markets given the anticipated decision? How is the financial market, especially the Nigerian banking sector, expected to react to this?
Well, when they keep rates at current level, it simply means what they want is what you may call to maintain status quo. What that means is that the level of liquidity in the economy will still remain about the same, other than injection that will come from electoral expenses and other related injections coming from the executive arm of the government. The reality is that as it stands today, the most effective arm of government in terms of maintaining economic stability is the monetary segment of the economy, or the monetary authorities. As it stands today, we are seeing a lot of vacuum in fiscal space because, one, those who will be driving the budgetary activities of the federal government are active in the field campaigning for the next election. So what is left to manage the economy is the monetary authority. And they have to keep battling to maintain macroeconomic stability at the point when there will be a lot more injection into the economy in the next couple of weeks as a result of election and electioneering activities.
Now, how do we reconcile this monetary policy tightening with the complaints by investors of high interest rates? Will this action not worsen the problem of high cost of funds in the economy?
Yes, but you know, I always say this, that managing the economy is a delicate balancing act. Investors, borrowers want cheaper funds, but the monetary authorities have the primary objective, which is to maintain price stability. Should they allow for an upsurge in the system, in level of system liquidity, you're going to have pressure on the exchange rate, which did lead to the valuation or depreciation of the currency. You're going to have further pressure on the consumer price level, which will lead to a further uptick in inflation. And these are some of the two key parameters that the monetary authorities manage, or the central bank is supposed to manage. So in as much as investors, borrowers, those in the private sector, real sector wants lower funding source, the monetary authorities have to balance between making available to them lower cost funds as well as maintaining price stability. As it stands today, because of the heightened political risk, even if you lower interest rates, you're not going to see banks lending because the banks are going to hold back their credit until they have some clarity on the economic direction of the country. So in effect...
okay. Go ahead, Mr. Chibune.
In effect, lowering interest rates today will not have any material impact in the level of credit available in the system.
Okay. It will seem it's only monetary policy actions that we see in trying to correct some of the macroeconomic challenges in the economy. Not much seems to be happening on the fiscal side. What's your view on that?
Well, that's why I said earlier that as it stands today, the monetary authority seems to be the only arm of the economic management team that is active in trying to maintain macroeconomic stability. What are those segments of the fiscal authority that should drive the economic activities? One, you have to, the key most critical element of, or the most critical tool that the fiscal authority has is the budget. As we know today, though they are still running the 2018 budget, but the 2019 budget is now in abeyance in the National Assembly. It is very, very unlikely that the National Assembly will be in a position to pass the 2019 budget into law before the end of the second quarter of this year, as all of them have gone to the field to canvass for re-election or campaigning for those they are supporting. So as it stands, and then the key ministries that drive economic activities at the fiscal end of government activities are the Ministry of Finance, the Ministry of Works, Housing, and the Ministry of Trade and Investment and Budget Office and other stuff. You can also agree with me that those who are heading those ministries are also in the field, actively engaged in political activities. So you see very minimal policies coming from the fiscal side. I'm not sure I've heard anything tangible other than last 2 weeks or thereabouts, or last week's meeting that they had with the economic management team had with private sector operators, so to try to present their balance sheet of what they have done so far. But in terms of policy direction, we're not seeing that. In terms of the key policies that will change the shape and nomenclature of the economy, you're not likely going to see that until the swearing of a new government.
And so can the CBN really achieve much without the fiscal policy?
Well, there's a limit to the effectiveness of monetary policies in the absence of, or in the near absence of fiscal engagement. And the central bank governor has said this repeatedly, that at several presentations of the MPC meetings, the CBN governor urged the fiscal authority to step up their act so as to make the monetary policies more effective. The monetary policies are designed to maintain largely price stability. You also need to stimulate the economy. Stimulating the economy is beyond injecting liquidity into the economy. There are infrastructural gaps that we need to address. Beyond the issue of infrastructural gaps, there are critical policies that could change the direction of the economy. Take, for instance, the issue of petroleum product subsidy. The latest figures say that the government spent about 1.4 trillion naira on petroleum subsidy. That is basically going to be a decision that the fiscal authorities will take. But if you take out that subsidy, you're going to free up a lot of liquidity for in development of fiscal infrastructure to improve the ease of doing business and make it easier for the transmission of monetary policies.
All right. Thank you very much for your time, Mr. Chukwu. Johnson Chukwu is the CEO